Howdy, Jacob here. Today we're looking at Choice Hotels International in the hotels, restaurants, and leisure industry. 5.9 billion market cap, 7 billion enterprise value. Founded in 1939 out of Maryland. They operate as a hotel franchisor in the US and internationally. They operate under Comfort Inn, Comfort Suites, Quality, Clarion, Sleep Inn, all those other ones. So 24.8 PE currently, high price to book, growth of almost double in revenue over the last 10 years. So that's very interesting. Huge growth the last couple of years. I mean, this one, 2020 to 2021 makes sense. Huge drop from COVID. People went back to what they were doing pretty quickly. No surprise there. But 31% in 2022, interesting. 10% the last year, also very interesting. With gross margins, operating margins, fairly consistent outside of the COVID years and very high. Operating margin of high 20%. That's immense. Dividend per share, they do pay a dividend. It doesn't look very substantial in relation to their earnings per share, so their payout ratio is likely not substantial. With a huge return on invested capital, huge return on asset, that is very positive. Let's look at their balance sheet. So their balance sheet, what is going on, internet? Come on. Balance sheet shows 27 million cash on hand with 499 million in short-term debt, 1 billion long-term debt. So they're going to really have to figure out what to do with that 499 million with only 27 million cash on hand. If you were to want to invest in this company, I would definitely want to make sure you know what's going to happen with their debt situation before you invest, especially short-term debt. You don't want it to get within 3 months, 5 months, whatever. The second it goes short-term debt, I think it makes the most sense to either pay it off, which they can't do, or refinance it. And the worst thing it can do is get as close to its debt date, and then they can, come and harm you. So that's not exactly ideal situation. But outside of that short-term debt, long-term debt, even at $1 billion, is about 5 years. Their 5-year average, let's say it's about 200 million. So it's about 5 years, their 5-year average free cash flow. And I mean, that's on the higher end for sure as well. So they're going to have to really figure out what to do with this debt situation. It's not just capital leases. There is a little bit of capital leases, but it's also a good amount of long-term debt. And so when you look at capital expenditures, they are reinvesting into themselves quite a bit, which we can see through their capex going up 400, going up a huge amount, 5 times. Cash from operations going up a little bit as well, but free cash flow is pretty similar-ish, maybe just a little bit higher than it was 10 years ago. Their use of free cash flow is very heavy on the share repurchases. The dividend yield of almost 1% is maybe 30% of their 5-year average free cash flow. So not a terribly huge payout. Otherwise, just share repurchases and acquisitions. So let's start making our assumptions here on the revenue growth side. I think I'd be pretty comfortable with 5% growth. I think 3% for this type of company is very easy, and then just the extra 2% from acquisitions seems to make sense to me. For margins, it's been consistent outside of COVID, but really let's look at a 20 and 18%, which are very, very good margins. Share repurchases, 1% would be about $60 million. Stock-based compensation, about 100. And that'd be about 50% of their 5-year free cash flow. I think I'm good with that. Dividend being about 30%, leaving about 20% to acquisition. That might be too much. So let's limit share repurchases since it's really just been heavy the last couple of years. Let's limit it to just the 50 million. So this is saying about 25%, 20 to 30% share repurchases, 20 to 30% for their dividend, 20 to 30% for acquisitions, and then the remaining amount for debt reduction. The dividends have been all over the place. I'm going to increase those a little bit less than revenue because I want the payout to dampen down to maybe 20% because I want this company to focus on debt reduction for a bit. So terminal PE 5%, enterprise value a little bit higher. It will do 14, 15% return. Has to drop 61% before you get the return we're looking for here. I think my only concern with this, or my biggest concern, was definitely be that short-term debt, as high as it is with the cash that they have on hand. Otherwise, I think everything else looks pretty promising except for the price point. And so I'll just be waiting until it gets to a more attractive price before I do any more research. I hope you enjoy the video and have a great rest of your day. Thank you.